Welcome back everyone, Happy New Year to you. In today's video we're diving deep into the critical concept of candlestick closures. Understanding how and when candlesticks close is key to spotting reliable entry and exit points. So whether you are new to trading or looking to refine your skills, this simple yet powerful tool can make all the difference in your trading. Let's jump into it. So one of the first things candlestick closures tell us is it confirms price action for us. If price action is running up higher and we have a key level, but this candlestick fails to close above it, it confirms that price action is likely to turn around and head to the opposite direction. Something else it does is it confirms reversing signals. So it keeps us out of false moves in the market. If the market is busy consolidating and we fail to close below this low, it confirms that we are likely to trade higher. If we close below, that can be a potential signal that we are likely to trade lower. Something else it does, and this is vitally important, is it confirms key levels like order blocks, fair value gaps, swing highs, swing lows. It confirms PD arrays for us. Remember with my order block video, an order block is consecutive candles that takes out liquidity that gets closed above. Again, what did I say? It gets closed above. If this candle fails to close above the down close candles, this order block has not yet been confirmed. So we can't take a retest of that order block because we are just busy ranging. We haven't confirmed that order block yet to take a retest of that level. So one of the reasons why I always wait for candle closures is because it confirms key levels in price action. And the final thing that candlestick closures helps us with it helps us with stop loss placement. If we know that a swing high or low is formed and it can be a potential protected high or low, we know where to place our stop loss. But unless the candlestick hasn't closed yet, we do not know whether or not we can trust that high or low to be protected. In this example, you can see here that we have confirmed a swing high. This candlestick's high is higher than this high and this high. So here we have a valid swing high. This is also considered to be a liquidity pool or buy side liquidity over here. Now, when we trade back above, we can see that this current candle has wicked above this level. But in order for that wick to form, this body had to be trading above this candle's this high. And so if you saw this as this body was busy printing, you can potentially expect a closure above, and you can place a buy order here with stop loss here at the low and your target here. And you would have gotten burned on this trade because you thought that this body would close above this swing high. But if we wait for the candlestick to close, we can see that we failed to close or displace above this high, leading us to believe that we have a lack in momentum. If price action, and I want you to think about price action like an army. If this army of soldiers isn't strong enough to push price action above the high and they fail, where are they likely to trade back to? The opposing liquidity. If we fail to close above buy side, we are seeking sell side. If we fail to close below sell side, we are seeking buy side. And I want you to remember that. We failed to close above buy side liquidity, and so we are drawing towards what? We are drawing towards sell side liquidity. And here we can see we interact with sell side liquidity. We fail to close below the level. Instead, we close back above. Now, what did I just tell you? If we fail to close below sell side, we are seeking buy side. And here we can see that we have buy side liquidity in the form of this swing high. This candle closes above it, so the momentum is there. The strength, we have the strength in the market. And so because we have that strength, because we have displacement, we have fair value gaps, we can believe and we can anticipate price action to carry on running higher. Are you looking to scale your trading to 6 figures in 2025 and actually become a consistently profitable trader, leaving your 9 to 5 behind? This is the program that you need to follow. I have been trading for more than a decade and I have made multiple 6 figures from trading alone. And guys, I believe me when I say I know exactly what you need to follow. I know the steps you need. I know the strategies you need. I've been where you are. I've tried everything. I've failed. I've blown multiple accounts. And I've become a consistently profitable trader. And I've been trading full time for multiple years now. I have used the models that I'm going to teach you to get funded and fund my personal account using prop firm payouts. So I do not rely on prop firms anymore. I'm a completely independent, profitable trader managing multiple six figures. If you are struggling to get funded, you can join my live trading sessions and I will trade live with you on a weekly basis until you get funded. And if you don't want to take my word for it, go ahead and read the reviews that this program is busy getting. I guarantee your success because I know what you need to use. I know what you need to follow. And believe me when I say it is not that difficult. People make trading more difficult than it is. And there's a reason why I've called the company the Simplified Trader, because I show you exactly in a simple step-by-step format what you need to do and how you need to look at the market in order to catch winning trades. So in this example, what do we have here? Over here we have that swing high, and that's confirmed because the high to the left and the wick to the right is lower than the middle wick, leaving this a swing high. So I can go ahead and mark that out as my liquidity point, and if we can see if price action comes back and interact with that swing high, we can see here that in order for this wick to form, this candlestick had to trade all the way above it, potentially forming this two down close candles as an order block, potentially confirming that. But instead of closing above, we failed to displace above the high. So automatically, I want you to look where. If we fail to displace above a high, I want you to automatically look at the closest swing low. And that will be my draw on liquidity. And so we wait then for the market to trade to that low, and then what happens? Do we close below it? No, we failed to close below it. So where do you look now? Now I want you to look at the closest swing high as the next draw on liquidity. Now, if we play this ahead, what can we see? Do we close below this low? No, we fail to close below the low. So again, we are looking at the swing high as our draw on liquidity. And what happens there? We get it, and what happened? Do we close above it? Yes, we do. So now that we've closed above it, we can look at the next points of interest, which will be this swing high. So then this becomes my next draw on liquidity. And we can see if we go ahead and we get there. Do we get there? Not yet. Instead, we trade back into where? We trade back into this order block before we trade higher. But now we have formed a new swing high. So that becomes my draw on liquidity. And do we get it? Yes, we do. Do we close above it? No, we don't. We failed to close above it. So I'm expecting this market to run lower before continuing higher. So let's see what happens. Instead, we do run a little bit lower, not quite to the swing low. Nothing in trading is 100%. Instead, we trade higher and we end up hitting our long-term target, which was the swing high. Do we close above it? Yes, we do. We close above it. So now I'm looking for the market to run to this swing high. Do we get it? Not quite yet. Let's see what happens. And the market eventually runs higher. But before we do, I want you to bring your attention here. What happens here? If I go ahead and I bar replay this, what do you see? We have this swing low over here that we failed to close below, leading me to believe we are seeking bullish price action. Instead, we trade lower again, forming this swing low. We trade lower again, we sweep the liquidity, and do we close below? No, we don't. We sweep the liquidity and we trade into this fair value gap. What does that lead you to believe? Remember, we go from expansion into consolidation into expansion. Now, because we have failed to close below the swing low, we have also traded into this fair value gap and we have resting liquidity above these highs. What do you expect the market to do next? Run higher to take out liquidity. And now we have closed above it. And so now we can expect bullish price action. And ultimately we run higher. And so that is how you can quickly see and look at displacement versus lack of displacement. Do we have a liquidity sweep or do we have displacement? If you look here as well, what do we have here? If we go over here, what do you have? We have this. Here you can see we have these swing highs. Do we close above it? No, we don't. We fail to close above it. What does that lead you to believe? That leads you to believe that we are seeking bearish price action. Guys, I want you to remember this. If we fail to close above an old high, instead we close below it, that leads you to think that we do not have the enough momentum and strength in the market to carry on with the momentum. And so because we have a lack of momentum, a lack of displacement, we are looking at the opposing liquidity. Now here you can see we fail to displace above these highs. Instead we run lower, and what happens? We displace through these old lows. So now where does your eyes draw towards? Your eyes immediately draw towards this swing low. So build a story with me here at the moment. We run higher. We fail to take out the old swing high. Instead, price action prints a failure swing, a lower high in a different term. It's the same thing, a failure swing or a lower high, same thing. We fail to continue on with the trend and we make a lower high. So now we are looking at taking out the lows. We've taken out the lows and we've closed below it. So now I'm looking at this as my draw on liquidity. Now I can go ahead and drop to the 5-minute time frame. Remember that we go from the hourly to the 5-minute. And so now I can look to frame trades until I hit this draw on liquidity. I'm just going to pull up my magnet emoji as my draw on liquidity, and we can look towards PD arrays in price action. Here we have a fair value gap. Over here we have an order block. So let's see if price action can come back into these PD arrays before running down lower. Let's wait for that to happen. Do we get that? There we do. What do we get here? So here we trade into this fair value gap. I can go ahead and mark that as a fair value gap. We run liquidity, which is known as a turtle soup. Turtle soup. So we sweep liquidity, run into a fair value gap, and look at the candle closures. This candle completely engulfs this candle, making this what? A valid order block. So there you can go ahead, take a retest of the order block, stops at the high, and we can target a 2R. Let's see how this trade plays out. If you look here, we can see we trade back into this order block and we start pushing down lower. Let's see. Unfortunately, we get stopped out and the market seeks out liquidity first before dropping lower. And I'm showing you this losing example to show you that nothing in trading is 100%. That is why we need to get a statistical advantage over the market. And I'm looking to teach you how to trade properly. I don't teach you a 95% win rate strategy because it doesn't exist. I'm teaching you sustainable long-term trading. Now that we have this failure, what happens now? Now we go ahead and we sweep liquidity again, and do we form an order block? As soon as we close below these consecutive up-close candles, the new order block gets formed. And so here we have our order block, and what happens here? Price action retests the order block, stops at the high, and we can target a 2R. Quickly, efficiently hits a 2R. So we have minus 1R plus 2R. That leaves us with plus 1R for this session. In this example, I'm going to show you how a candlestick closure can form PD arrays. So remember, what do we have here? We are waiting here for a liquidity sweep, which we get. We have a sweep above these old highs. And so in order for an order block to form, we need a candlestick to close below this opening price. because this is the opening price of our up close candle. So as soon as we close below the opening price of this up close candle, our order block gets formed. And so now we have to wait for a body candlestick closure to close below, a body closure. Do we get that body closure below? Yes, we do. So now we have our order block that gets formed. And why isn't this green candle our order block? Because this is the candle that took out liquidity. If this wick was higher, that would be my order block. But that wick isn't higher, so it's not my order block. So I can go ahead and either I can place a retest, stops above the high, target at 2R. I can do that. You can trade like this. But if you want to go ahead and refine this further, we go from the 1 hour, we drop to the 5-minute time frame. So now we are looking at taking entries within this order block. First of all, we want the market to trade back into our order block and then give me some sort of liquidity sweep with an order block. So I'm waiting for a liquidity sweep. So I'm waiting for a swing high to get taken out. Here we have a valid swing high that forms. So I'm waiting for this swing high to get taken out. This will be my liquidity sweep. So let's play price along and wait for that swing high to get taken out. What happens here? We take out that swing high, and now we are looking at forming a new order block on the 5-minute time frame. That is how you pair time frames together. You have your liquidity sweep with order block on the 1 hour time frame. Now you want your liquidity sweep with order block on the 5-minute time frame, which in this case will be your entry time frame. And that is how you pair time frames together. So when we close below this up close candle, that will be the formation of my new order block. But we have to wait for a body close. Do we get our body close? Yes, we do. And so that is where you can take a trade. Either you can take a market execution, stop loss above the high, target at 2R, or you can take a retest of the order block. I'm just going to do both. Stop loss at the high, target at 2R. So this is market execution. This will be a retest of this order block. Drag that along so you can see. Let's see how this plays out. In this case, a market execution would have paid you. Let's see if price action comes back to retest that order block. So here we come back. We retest the order block. Let's see if it runs down. And there you go. Both trades would have given you a 2R. And so that is why it's very, very, very important to wait for candlestick closures. If I go ahead and zoom in here again, we can see that we failed to displace above this high. So my eyes drop where? To this swing low. Let's see if we get there. And there we go. We failed to displace above the high, and my eyes draw to the closest swing low. If we closed above this swing high, I would have been looking at this swing high for the market to draw towards. That is why waiting for candlestick closures is so vitally important. Guys, I hope you learned something in this video. I hope you enjoyed the video as always. If you did, leave a thumbs up, leave a comment. I do respond to every single comment out there. And I hope you have an amazing rest of your day. If you're looking to trade live with me and get mentored by me, go check out the link in my description. And I'll see you guys in the next video.